I'd like to start this video series off by doing a little introductory lecture to the concept of time value of money, or what we also refer to as TVM for short, time value of money. So in taking some notes, the first thing that I want to address is what really are the key questions associated with this? And the key question is one of valuation. And so for valuation, we really think about valuation is about identifying when cash flows happen. They either come into you, makes us happy, they go out from you, oftentimes does not make us happy, and they happen at specific points in time. They could happen today, next month, in 20 years. You could get money in or out at any given points of time. And at any given point in time, you always have the fundamental opportunity to do something else other than what your specific choice is. That could be invest in stock A versus invest in stock B. That could be put your money in a savings account at one bank versus putting your money in a savings account at a different bank. And oftentimes, because the future can be so uncertain, we like to think about those things in present value terms. So, valuation is just a way of saying, what is the dollar amount associated with my choices? So, I like to use a process whenever I do time value of money. And so, time value of money for me as a process is always going to start by reading a problem twice. So, for example, we're going to do a problem in the next video about what is the future value of $100 invested for 10 years at 10%. I always like to digest it by reading that thing twice. What is the future value of $100 invested for 10 years at 10%? Once I've read that twice, the next fundamental step is documenting your assumptions, which is basically the process of labeling and typing in everything you know that may or may not be used in the calculation of the answer. Because you're going to find in this section that Excel has some very purpose built formulas and functions in it that will help us calculate time value of money. Also, then, we have to be cautious in thinking about the way that Excel presents the numbers versus the way you would do it in simple algebraic terms. There's something specific about the way we think of an investment, where an investment to Excel means a commitment of capital or an outflow, a negative that may or may not confuse a user when you're trying to explain it to them. Because ultimately, the value add that we have is to interpret the results. What does this mean? Should you do X versus Y? Is really what time value of money is trying to help us understand. When we do time value of money questions, then we're going to use a series of variables. And the variables fall into three different categories. Category number one is the king, cash flows. And cash can flow different ways. It either comes in, it generally makes us happy, or out, generally does not. It can happen now, like today, or it could happen anytime in the future, 1 month from now, 2 months from now. And it could happen one time. I get $100 in 2 months, or it could happen on a recurring basis. I need to pay $100 every 2 weeks for the next 3 years. So cash flows is the first most important one. Then is the notion of what my opportunity cost is, or what is the rate of return that I could earn if I did not only this, but something else that has equal risk associated with it. And then the last thing we need to think about is, and I just closed that by mistake, so we're going to open it back up again. And that was this one right here, Alt HFC. There we go. Is the time expressed consistently with those variables, whether it's in days or months or quarters, etc. So those are the three variables: cash flows, rate, and time. We also then will have formulas that, if we wanted to, Excel just knows that there are formulas that exist in the world for present value, for example. The present value formula is just simple algebra that's built into Excel. We also have formulas built in for future value, and we also have formulas built in for a payment and for a rate. And those are built into Excel in specific ways such that we can navigate to them a couple of different ways specifically. And one of the ways would be using the formulas menu, where under the formulas menu, there's actually a financial category where there's drop downs for all of the different formulas we'll use, like FV for future value and PV for present value. Alternatively, you'll also see that one of the navigations you can use is we could just type in equals PV and then open a parenthesis, and then it brings up the series of variables for us that we can then pick and point to identify. So, time value of money is really the process of us adding value by thinking about cash flows that exist over specific points in time and then thinking about the opportunity cost that we have so that we can make good investment decisions. So, here is a page of notes for you that will help guide you in terms of the series of videos we're about to produce that give a sample of how to calculate these different valuations using time value of money.